A single class action settlement totaled $2.95 billion. It was only one chapter in a scandal that fused oil, politics, and kickbacks. What was at stake was not just the balance sheet of Petrobras, Brazil's state-controlled oil giant, but public trust in how a commodity windfall should be managed in a democracy. Petrobras sat at the heart of Brazil's economy and national identity, controlling massive offshore reserves and commissioning multi-billion-dollar work across refineries, platforms, and pipelines. In theory, the company answered to investors abroad and the Brazilian state at home, under a lattice of compliance expectations. Brazil's Clean Company Act and public procurement rules on one side, and because its securities traded in New York, U.S. disclosure duties, and anti-bribery statutes on the other. The system depended on competitive bidding, internal controls, independent audit, and regulatory oversight. In practice, a decade of opaque contracting, political patronage, and weak challenge functions created the conditions for a scheme that investigators would brand with a name known far beyond Brazil: Petrobras Lava Jato, Operation Car Wash. The cast was sprawling but legible once you followed the incentives. At the center stood Petrobras, a Rio de Janeiro-based state-controlled energy company with executives responsible for refining, engineering, and services who had authority over budget and scope. Around it clustered Brazil's largest builders and industrial conglomerates, firms that won enormous contracts for mega projects and enjoyed privileged access to procurement calendars. Inside the political sphere were party treasurers, elected officials, and appointees who allegedly converted corporate overcharges into campaign financing and personal enrichment. On the law enforcement side were the Brazilian Federal Police and the Federal Prosecution Service, joined by the Office of the Attorney General, auditors at the Federal Court of Accounts, and later cooperation with Switzerland's authorities on cross-border flows. Across the equator, the U.S. Department of Justice and the Securities and Exchange Commission scrutinized filings to American investors and potential violations of anti-bribery and disclosure rules. Add to this an ecosystem of money laundering intermediaries, black market currency dealers, offshore shell companies, and accommodating service providers, and the machinery for turning public contracts into private reward snaps into focus. Each actor had a role: inflate, funnel, conceal, and when pressure mounted, deny or cooperate. The timeline starts before the dramatic raids. In the late 2000s, Petrobras launched an ambitious capital expenditure cycle just as Brazil surfed a commodities boom and discovered pre-salt oil fields. By 2010, investigators would later allege a cartel of major contractors had begun to pre-arrange bids, inflate invoices, and kick back a fixed percentage of contract values to corrupt insiders and political operators. In 2014, a set of search warrants tied to a currency exchange probe unexpectedly opened a doorway into Petrobras contracting, and the first cooperating witnesses, among them a former downstream director and a black market money dealer, described how overpricing worked and who benefited. In 2015, cases expanded to leaders of top construction groups, and the first criminal sentences landed against industry executives in Brazilian courts. In 2016, a landmark wave of plea and leniency agreements crested, with one of Latin America's most powerful engineering conglomerates admitting to a long-running bribery operation and accepting a multi-billion-dollar penalty split among Brazil, the United States, and Switzerland. For Petrobras's investors, the financial reckoning sharpened in 2018 when the company agreed in U.S. court to resolve a securities class action, and U.S. authorities announced coordinated resolutions that framed Petrobras as both victimized by corrupt executives and responsible for misleading statements in its public filings. This is our hard stop. Facts through the end of 2018, when Brazilian prosecutions and U.S. enforcement produced their first round of landmark outcomes. Mechanically, the scheme was disarmingly simple and devilishly persistent. A rotating cartel of construction giants allegedly decided in advance who would win Petrobras tenders. The chosen firm submitted a bid that looked competitive. The others entered deliberately higher or technically non-compliant proposals to preserve the appearance of rivalry. Once the award landed, the contract value grew via change orders, unexpected scope expansions, and pricing assumptions that were hard for outsiders to test. A slice, often described in testimony as a few percentage points of the total, was siphoned off as kickbacks and campaign finance. Money moved through consulting invoices to front companies, transfers routed through offshore jurisdictions, and black market dealers who exchanged checks and cash with remarkable speed. Cash deliveries still mattered when deniability was the priority. Inside Petrobras, the arrangement required gatekeepers in key directorates who could steer scopes, shape technical specifications to favor certain vendors, delay or accelerate milestones, and leak what would pass a committee's threshold. On the vendor side, cartel discipline ensured that everyone took a turn and the spoils were shared according to a schedule. From the outside, each contract looked like a standard mega project in a complex, capital-intensive industry. From the inside, the playbook turned procurement into a toll booth where influence was monetized. Follow the money, and the incentives clarify why the system endured. For the cartel, coordination traded some margin for certainty. Guaranteed awards on a rolling basis meant predictable backlog, leverage with banks, and executive bonuses tied to revenue and project wins. For corrupt insiders, the kickbacks were immediate, and political operators converted flows into electoral muscle or factional loyalty. For the company's reported results, inflated capital expenditures fed inflated asset values, and impairment calculations arrived late, masking true performance until write-downs became unavoidable. Investors, relying on audited statements and public disclosures, could not see the embedded overpricing. The incentives to blow the whistle were weaker than the incentives to keep quiet, until a few arrests broke the equilibrium. Cooperation agreements offered a path out for participants who no longer believed the silence would hold, and once the first detailed proffer arrived, investigators could triangulate bank records, email traffic, and contract histories with increasing precision. Controls failed at several layers, and understanding those failures is where the governance lesson sits. Internally, Petrobras had procurement committees, segregation of duties matrices, and an internal audit function on paper, yet they were outmatched by organized collusion. Single-source justifications proliferated. Project teams reused vendor-friendly specifications across different sites. Price reasonableness checks relied on benchmarks supplied by the same ecosystem that benefited from higher baselines. The internal audit group faced data bottlenecks and management representations that omitted the existence of bid rigging. Externally, oversight bodies confronted information asymmetry and political pressure. Auditors met the limits of sampling when the sample frame itself had been shaped by a cartel. Where red flags appeared, repeat awards to the same cluster of firms, change order spikes in early phases, margins above industry comparables. No single actor had both the mandate and the political cover to convert concerns into decisive action. A culture of national development exceptionalism, the belief that speed in procurement served the country, blurred the line between pragmatic shortcuts and systemic abuse. That blurred line became a highway. Enforcement and litigation shifted momentum and established accountability within the relevant jurisdictions. In Brazil, arrests, plea bargains, and leniency deals recovered funds and produced detailed accounts of bid rigging and bribery within Petrobras contracting. Courts issued sentences against executives who admitted roles in overpricing and money laundering. In 2016, a major Brazilian engineering conglomerate acknowledged in criminal papers a structured bribery operation that spanned years and countries and accepted a historic penalty coordinated by prosecutors in Brazil, the United States, and Switzerland. For Petrobras, exposure in the United States flowed from its capital markets footprint. It raised money from American investors and filed reports with the Securities and Exchange Commission. In January 2018, the company agreed to resolve a securities class action in New York, brought by investors who alleged that undisclosed corruption and inflated asset values had misled the market. In September 2018, U.S. authorities announced resolutions that treated Petrobras as having been harmed by its corrupt agents, yet responsible for material misstatements and omissions in its filings. The Justice Department grounded its analysis in anti-bribery and internal controls concepts, and credited Brazilian recoveries and investor restitution. The securities regulator detailed how omissions deprived investors of facts they needed to price risk. These outcomes, all before the end of 2018, closed an enforcement arc that began with domestic raids and ended with cross-border accountability. Victims and fallout spread across the economy. Taxpayers paid first through inflated project costs that drained a strategic enterprise, and again through slower growth when projects ran late, were cancelled, or required impairments. Shareholders, including pension funds and retail investors in Brazil and abroad, suffered losses as Petrobras marked down assets, and its market value whipsawed during headline-driven months. Honest employees saw a company they were proud of become a byword for scandal, and career prospects dimmed when the oil and engineering sectors retrenched. Competitors who refused to join the cartel lost bids they might have won, and the broader supply chain endured a credit squeeze as banks repriced risk and demanded stronger covenants. Internationally, the case chilled appetite for large, state-linked engineering ventures across the region, and counterparties demanded more documentation and stricter compliance representations in contracts. The reputational damage was not abstract. It translated into higher cost of capital and more intrusive oversight for years. The mechanics of remediation mattered because they shaped how trust could be rebuilt. Internally, Petrobras launched compliance enhancements that emphasized independent cost engineering, stronger vendor onboarding, and analytics aimed at detecting bid patterns inconsistent with competition. The aim was to move from paper controls to controls with teeth, mandatory cross-functional review for change orders, rotation policies for sensitive roles, and procurement data lakes that allow pattern analysis across business units. Externally, settlement frameworks tied penalty credits to cooperation, restitution, and governance reforms. Investors demanded more granular disclosure around capital spending and impairment triggers, and auditors widened the aperture on related party risk, beneficial ownership checks for vendors, and the use of third-party consultants. None of these steps rewound the damage, but they drew a map for how a state-influenced issuer can operate in public markets without replicating the same vulnerabilities. There are lessons here for boards, auditors, investors, and citizens. In mega projects, numbers that look plausible in isolation become implausible in pattern, so pattern detection is not optional. Track who wins, how often, and on what terms. When change orders cluster early, or when a small circle of vendors captures a dominant share, those are not coincidences, they are risk signals. Too technical to question is not a comfort, it is a tell. Boards need independent cost engineers who can challenge baselines and assumptions, not just accountants who certify arithmetic. Money rarely moves without footprints. Even where shell companies and informal dealers play a role, there are recurring fingerprints. Consulting invoices from entities with no real staff, payments to jurisdictions with no project nexus, and service providers popping up across unrelated contracts. Incentives beat slogans. When executive pay emphasizes volume over verified value, and when political calendars drive launch dates, procurement turns into theater. Align bonuses with life cycle performance and verified cost savings, and you shrink the room for padding. Finally, disclosures are not a footnote exercise. When a company is touched by a major domestic probe, it must quickly assess whether prior statements remain accurate in light of what has become reasonably knowable. Waiting for every legal thread to finish before updating investors is a recipe for litigation risk and reputational drag. If you came to this story searching for villains, you will find plenty. If you came for systems thinking, you will learn more. The scandal thrived where complexity met complacency, where national development rhetoric dulled skepticism, and where cross-border enforcement lagged the speed of money. Yet it also shows how cooperation can work. Domestic prosecutors unravel a scheme, foreign regulators translate that into securities law accountability, and investors claw back part of their losses. None of this erases the waste, but it sketches a route to do better the next time ambition meets opacity. If this kind of deep dive helps you navigate finance with clearer eyes, consider subscribing and sharing it with someone who follows the energy sector. The more people understand how kickbacks hide inside normal-looking contracts, the harder it becomes for them to survive in the dark.